The central bank stunned the market last week by keeping the NPR at 27%, despite 7 straight months of falling inflation. Is that a missed opportunity or prudent caution by the Apex Fund? The FGM bond auction was oversubscribed by about 143%, with yield continuing to grind lower. The NGX is clinging to a remarkable 39% year-to-date gain. That's despite local and global headwinds. And at the close of market on Friday, First Bank announced its final or total divestment from FBNQuest. It's the bank shoring up capital for the recapitalization raise. Also from Monday, the entire market is going to switch to a T+2 settlement. What does history tell us when we switch a settlement day? We'll talk more about that later on. The NTB auction, which is the Treasury auction, is also going to take place this week. Are we going to see yields continue to come down lower? Right. So joining me to really discuss all of this, I have two guests joining me. First, joining me here is Oladipo Ajayi. Oladipo Ajayi is the head fixed income and vice president at Chapehil, Denham. He's joining me today from the Dipo, where are you? You've been traveling all around the globe. Where are you at the moment? You are muted. You are muted.
Hello.
Yes, you're muted.
Are you hear me?
Yeah, I think your camera needs to be properly placed.
Are you sure it's my camera or your camera today?
No. Yeah, no. Yes, you better now. So
Okay.
I was saying that I don't know where you're joining me from, that you've been traveling around the globe in the last 1 week. Where am I speaking with you from, Dipo?
Well, I'm joining you live from London currently.
Okay. All right. Welcome, Dipo. I also have joining me today Andrew Esene. Andrew Esene is an assistant vice president at FCSL Asset Management. Andrew, how are you today?
I'm doing well, Doctor. Thanks for the invite. Evening, Dipo.
Yeah, good evening, Andrew.
Yeah.
Right. You guys have met before, right?
Yes, we have.
I think we've met before.
All right.
Yeah.
Just let me be sure that I don't have strangers here. Okay. So welcome, Dipo. So last week, obviously, when we met, you had your expectations from the MPC. You were expecting a 25. You're expecting at least a 100 basis point cut by the CBN. So was the MPC decision, did it come to you as a surprise?
Well, it's not peculiar to me because I think reports a day later also corroborate with my view around it, because a lot of people were surprised about the decision of the monetary policy guy to actually maintain status quo in that regard. But one line of thought that analysts are also looking at it from is that although they never told the NPR, but one way or the other, they also sent a dovish signal to the market with the adjustment of the corridor. Because what they've tried to do, what they've ended up doing is that they've been able to adjust corridor in a way that the overnight rate is now around 22.45%, compared to the 24.5% where it was trading for a long time. So one way or the other, what it also means is that they've been able to lower rate in that regard. But one thing is that the main measure of rates in the market still remain the monetary policy rate, and since they decided not to actually touch that, that sent a signal to foreign investors that we are still hawkish in that regard, and make Nigeria look like a destination where everyone to rush to.
Okay, thank you. Andrew, let me bring you in. What did you make of the MPC decision? So we've had 7 straight months of inflation declining? Was this a mixed opportunity by the Apex Bank to cut rates?
Just like Dick said, the general analyst expectation was a cut in rates. I was also expecting 100 basis points cut in the benchmark lending rates, but the MPC did cite inflationary pressures that still remain, and then even from global economies, the regional conflicts that we have, and the likely impact, of inflationary figures, of the inflationary pressures, affecting our own environment. So for that reason, they decided to keep rates high. So I don't think it's a missed opportunity. They'll still be meeting again in February next year, in a couple of months. And so if rates continue, if we see the key indices being watched, continue to head in the same trajectory, then that rate cut would likely come at the next session.
Okay, so you've been monitoring the stock market since the MPC had their decision. So we've seen some pullback. Is it still a time to buy the dip? Are we in the buy the dip territory?
I would think so. The key issues around that forced the pullback was really the uncertainties around the capital gains tax and then some profit taking. We have seen some clarifications from the government regarding the capital gains tax, its implementation kickoff, and then even the government willing to come to the table to discuss with market players as to how the implementation will take. And some parts of the press have even gone ahead to say that there will likely be a cut in the CGT. So that's the uncertainties around its rigid implementation has calmed down a bit. So that risk is no longer there. But so the pullback, why I think it's an opportunity to buy the dip, is because the pullback has unearthed more value, from falling prices where fundamentals remain the same. It means that, it's an opportunity for investors to buy. And then we are going into Q3 earnings season and then Q1 dividend season for 2026. So the horizon is positive. This will be a good opportunity for investors to consider buying the current positions.
Okay, yeah. Before we talk about the earnings season, let me bring Deepo back. So I think you already started talking about the forward guidance that might have been provided by the MPC. Do you want to talk more about that and how, compare that with what we've seen at this last auction? We had the auction that took place in November, oversubscribed by 143%, especially on the 7-year tenor. So is this forward guidance, is that what is pushing the interest in the bond market? Is that what is driving investment in the bond market, or are just banks simply trying to park their excess cash in high interest rate instruments?
Like I mentioned to you earlier on, Nigeria still remains a destination for any investor as we speak currently, and the rating agencies they've actually improved our ratings for the year, and which simply means that we expect patronage from most foreign portfolio investors, and beyond the equity markets. We've been seeing sizable interest in the fixed income side of the market as well. As much as a lot of foreign portfolio investors are looking at the OMO window for the short-dated opportunity, a lot of them are also looking beyond a 1-year horizon, and so they are trying to actually push funds into like a 10-year, a 7-year, a 12-year maturity in Nigeria. And so we've been seeing a lot of them coming to the market. So the activity we've been seeing in the markets is beyond the banking guys, because mostly I would rather say more of the the PFs, the portfolio managers as well, because currently a lot of them are trying to actually invest aggressively, and knowing fully well that the expectation is that by next year we expect rate to actually drop, and so now that MPC has decided to actually move the next meeting to February, between now and February, the main determinant of market activity remains special news that actually hit the market, and coupled with the level of liquidity in the market. And so this more the market will actually be feeding on until the next MPC meeting. And if the direction of inflation remains the same till then, it means that we should be expecting more like a jumbo rate cut by February. And so imagine that in February you now see a rate cut of about 400 basis points. Of course, I'm sure you'll be surprised 400 basis points, but don't forget that the first increase that we saw was also 400 basis points. Before we had another 200, we had another 150 basis points. So it simply means that in the same quantum, we can also decide to actually start reducing rates when we are so much convinced that inflation is actually we've been able to actually rein in inflation. And the focus of monetary policy guys is to actually bring inflation into more like a single digit corridor. And I don't think it's a difficult act because if we continue in this way, we'll likely get there. We've been there before during Sanusi Lamido's time. I know inflation was ranging between 6 and 9% then. So it's not something that's totally out of place. So we feel that the main catalyst that's actually driving markets is actually interest from portfolio manager rather than from bank. And like I mentioned, is the expectation that you're expecting in the future that rates will drop. So a lot of people are trying to actually capitalize on that as we speak. You mentioned something in the month of August, rate was not of 17%. Currently now, we are currently trading around 16%. But when you get to the secondary market, you barely can get 15.85 as we speak, because a lot of people are not ready to actually dispose there. A lot of people are holding this instrument as treasure. And when you look at where the belly of the curve are trading, and you look at long end, they're currently trading close to about 150 basis point spread. So it tells you where market is going, and it's also an opportunity for anyone to lock in.
Yeah, so I was going to, even come to you on that because we've seen from August to around November, we've seen about 100 to 120 to about 150 basis point drop. So I was going to ask, is this like genuine macro improvement versus bank and just pension funds being forced, in quotes, into the bond market because there's nowhere to go, there's nowhere to put funds at this time. Also, I wouldn't forget last week you had projected that the auction was going to stop at 15.8. Did you miss the analysis or what happened?
I think if you look at it critically, you see that the DMO actually oversold on the long end. So what they actually did was that they actually sold over 400 billion on that maturity. And one way or the other, that will actually push rates beyond because one of my view is that since the DMO they're already selling about 250 on that maturity, they will likely want to stop on that 250 mark. But what they did was that they sold far beyond what they actually announced on that particular maturity. So it actually pushed rates beyond expectation. And back to the issue of where rate was in August. And don't forget in January, we were at 22.8. And between January and August, the market has dropped close to about 500 basis points. And if you look at between that January and now, the main driver of market is a macro base. It's not sentiment; it's basically macro. And I remember vividly at that particular point, some of us were actually pitching that there's no other time for anyone to actually invest in Nigeria market than there. And a lot of people missed the bus there at 22 levels. And we were still saying at 18% that's still not a bad buy for anyone still buying. And here we are also still saying that if you miss the 22 mark, you miss the 18 mark. another room is there for you to actually still lock
at
in at
16.
16%, so that you won't get
So
to
16
13%.
is a good level
When
to
we get to 13%, I don't want to not be at that time that we will not be saying, oh, but we told you 22, we told you 18, and another window opened for you at 16, but you actually failed to invest. And to
Well,
be
yeah,
realistic,
yeah,
this thing
yeah.
is
So I will come back to you on where you see rates ending at the, at the close of 2025, because we're currently at 16 now. So maybe entering tomorrow, 1st of December. So we'll see where rates is going to close, but I'll get back to you on that. Let me talk to Andrew. Andrew, so we are entering into Q3 earnings season. So we're already expecting results. So which sectors are you looking at? And which ones are you thinking would actually uh, begin to create the momentum towards the end of the year that investors are?
Okay, as to in particular sectors, we've seen the consumer goods space come out of the FX losses that they suffered earlier in the year and towards the end of 2024. So by the time we we've seen them recover from that position, and so subsequent results, that do not have the impact of FX losses, when we overlay them against the corresponding period of the prior year, we'll see that jump in earnings. So that's that improved earnings could also positively impact their prices. That was the same for consumer goods, same for industrial goods as well, but mainly on the consumer goods. Another key sector to watch will be the telecom space. They also suffered FX losses, but they had an additional advantage from the telecom tariffs increase, which has positively impacted their revenues. So going forward, we'll see that filter into their revenues. And then when you do a year-on-year comparison, you see how much their revenue and bottom line has grown. So for consumer and industrial goods, and then the telecom space, are one that are three sectors that one should really pay attention to.
Okay, with the banking stocks now, they took a hit in October, November, and MPC obviously declined to cut rates. So with the fact that we don't expect a rate cut at least until February, what's the base case for banking stocks in Q4? Where do you see that? Where do you see banking stocks trading heading into 2026?
Well, going into Q4, I believe we'll see positioning for Q1 2026. The banking sector is highly liquid, so it attracts a lot of foreign portfolio and institutional investors. So that is why when the market is taking a beating, it leads in the beating. And when the market is recovering, we also see it lead in that recovery because of the liquidity in that stock. Given that the MPR was retained at 27%, and then lending rates are still like 600 basis points above the benchmark 27. I expect banking earnings to come in healthy because the environment has really not changed significantly. The rates still remain the same. In terms of interest income, the benchmark rate remains the same. So they are not likely going to bring down their own lending rates anytime soon, unless there is a change in the MPR. And then in terms of investment income, the yields in the fixed income space, largely didn't change as a result of the MPR. So I expect their numbers to come in healthy, but we will likely see positioning in that space because of Q1 2026 dividend expectations.
Yeah, so with MPC maintaining the MPR, we expect more, obviously, interest in the debt instruments and the NTB. So Deepo, there's going to be an auction this week, right? The
Yeah,
NTB auction. So what
yeah,
levels are you looking at?
yeah. Currently, if you look at the long-dated bills, because of what happened at the last auction, before the auction rate, we were trading around 1540, 1535 levels.
Yeah.
But the auction, we saw the aggressive posture of the DMO, where they sold over 1 trillion on the 1 year paper. And that actually pushed rates to around to close at 16.04. That is more like about over 60 basis points from where he was actually trading at the secondary market. That creates a bit of panic in the market, and a lot of people went at a lower levels, and so it means that they want far below where the auction stopped. And as we speak currently, the instrument is trading around 16% in the market. I mean, or bid, but offers were around 15.85. So it means that for anyone that is going to auction this week, we still want to bid around 16%. So it's not more like a do or die, because I would rather go and buy a 1585 in the market than actually going to the second primary auction to actually bid around that same level. So what I think that like the market would likely want to actually push around the 1590, 1595 to the market. Of course, we'll see a lot of people that would likely want to push rates the system, but I will take a bet around 16% for this week's auction. So my window will be around 1590 to 16%, considering that it's more like a permanent market.
Okay. Yeah, so sticking with you, Deepo, recently CBN announced that they are planning to migrate all fixed income settlement activities. We're also having that on the NGX, the stock market side, which I'll talk to Andrew about shortly. So the CBN announced plans to migrate all fixed income settlement activities to their platform for better oversight. Do you have any updates regarding this, and are there any teething issues that you've identified?
Of course, currently, we're seeing the CBN actually do that. But the face of it is that every auction, NTB auction will now go through um, S4.
Okay.
Before now, that has not been the modus operandi. But now the CBN has mentioned that so all auction around that actually will now go through S4, and I think just like what you mentioned, the view is to actually have the general oversight of the market. Central bank want to see who is bringing the money in, who is selling, who is buying, at what price, is it fairly priced, and of course a lot of people have a reservation around it, that the central bank is going beyond its uh, its right, or where its power to actually dabble into the area where the SEC are supposed to actually operate. But one way or the other, we've seen this actually play out in other jurisdictions. US Fed has done that. We've seen that also happen in the United Kingdom as well. So it's not something that's totally out of the market. But what the central bank is trying to say is that they are not actually crossing to the other side. What they are just trying to do is to have oversight of the more funds that comes in, the valuation, the pricing, and all other things in that regard. And they've been trying to actually do that. And of course, that one way or the other, it's actually working for now. Of course, would there be teaching? I'm sure by the time they move to the phase two of it, which more like getting all trade bonds and every other thing to actually trade and actually settle around that, or having oversight in that regard. There could be one or two things that they need to actually tweak in that regard, so as to be able to achieve their goal. But is it something that is achievable? Well, for me, I think it's not something very difficult for them to actually achieve. We've seen the central bank come in about this time last year when they actually introduced the MFM window. And between now and today, we've seen so much improvement and the level of activity in the FX market. We've seen price discovery, we've seen market depth, we've seen huge liquidity in the market, because what they did was to actually ensure the market to actually price the currency appropriately, and that's actually one way or the other instill confidence in the mind of investors that are looking to actually come into the market.
Yeah, I mean, I don't think there is anyone doubting the what the CBN is trying to carry out their intention. But I think what people have been talking about is this not like a self-review or self-interest kind of thing happening where you are now coming in to take over the settlement, which is more like of an operational aspect of the market, which the CBN itself is supposed to oversight. I know you alluded to some other regions or clients where this has happened, but I don't know whether, in spite of that, whether that still makes a case for best practice.
I think one thing that central bank is trying to do is that before now, securities are warehoused on S4. I mean, the federal government securities are actually warehoused on S4, and also the cash leg also move from central bank. So it means that both the settlement leg and also the other leg also are sitting with central bank already before now. So it's not something totally different. I remember those days where we used to settle through the CSCS, but
Yeah.
gone are those days. So before now, it's always been central bank because they have the cash, they also have the security sitting on their platform now. And I think what they are just trying to do is to actually take it a notch higher than where they used to be for clarity and also to actually ensure that market that they have full overview of the market. The central bank wants to see where funds are coming from, and I remember when the post PC meeting when the central bank governor was talking. There's something he said around the fact that as we speak, they know where all funds are coming in. You from so they know how much is coming in. They know where it's coming in. They know who is selling. They know who is buying in the market, and that is exactly what any central bank will want to do. You don't want someone to take your back and you can actually trace from. And I think that's exactly what they also want to see here. We know who is bringing the money, but we don't want to know where the person is taking the money into. Are you putting the money? Are you putting it in the bond? Are you putting in equity? So it gives an idea of that. So considering the peculiarity and the fragility of Nigerian economy as we speak currently in terms of the security architecture as well, the central bank is just trying to use that window to also play their role to actually ensure that they can
Yeah.
actually contribute to that.
Yeah, that makes perfect sense. It helps with a lot of transparency and accountability, helping to ensure that the central bank knows all about financial flows within the economy, so we don't have corrupt funds moving, trying to be polished into purchase of debt instruments. Okay, so there is also a T+2 settlement that is coming to play from this week. So historically, so going back into 2011, 2012, we used to have about T+5 settlement, if I'm not mistaken. Now moved to about T+3 with the CSCS enforcement. So at the time, we had daily markets, stock market transaction jump from about 3 billion to about 10 billion within a 6-month period. And the major beneficiaries were mid-cap stocks. Same thing in 2021, where we had some brokers now started to maybe pilot this T+2 settlement. We also saw some significant jump in turnover. Now, in 2025, we are now switching. The entire market is switching from T+3 to T+2 settlement. So, Andrew, do you expect a rotation out of the usual large cap stocks in December to the mid cap stock, because they seem to be the major beneficiary from these settlement changes? When did that happen in the past?
Okay, for the market, I don't have any historical data to support that mid-cap stocks will benefit from the shortened settlement cycle. For now, I think most players are seeing it as a new it's like a new policy, into the market. So we're just watching to see how it generally plays out. So it will improve liquidity. It's a faster turnaround time for investors and the rest. But as to the particular market segment, in terms of the cap tiering for stocks that it will positively impact, I really don't have any data to support that. We just watch and see how it plays out for the month of December, so we can then extrapolate and see what impact it will have in the new year, 2026.
Yeah, my bit of research that I did shows that the mid cap stock, like in 2011, the bikes of Honeywell, Nascon, Julius Berger, Transcorp, Oando, all had about 3 to 5 times return, while banks lagged. Obviously, when we moved from about T+5 to T+3. Same in 2021, when some banks or some brokers, quietly started this T+2 settlement. We noticed Fidelity Bank, Sterling, WAPIC, Livestock Custodian, all also grew their return in terms of turnover now, trading wise, about 50%, especially in Q4 of 2021. So that's why I'm thinking that we might also see this. And it's not only in our markets. India experienced this last year when it moved from T+2 to now T+1. Because what happens is that since it shortens that settlement time, it increases turnover. That's why I think that makes sense if we begin to see more activities around the mid-cap stocks.
Okay.
Yeah. Okay. So we also noticed that I think we were supposed to have the budget presentation. Was it supposed to be in November or sometimes in December? Because I'm thinking now that I think it's been delayed somehow to 2026 due to the delay in the MTEF presentation, because we've had about poor 2025 budget execution. So how might this CAPEX uncertainty drag the equity market?
Well, it's only in recent times that we started seeing the early presentation of the budget. It was commended because it gives a sense of direction, going into the new year, going into the new fiscal season for investors. But I think for local investors, it's almost when the budget comes, it comes, right? You just wait on the sidelines and see what happens. But in terms of CAPEX spending, so the government is allowed to continue implementing the budget into Q1 of the new year. So they will continue with, as long as they can find the capital to deploy, they will continue spending. They will continue implementing that budget, the current budget, into Q1 of 2026. And by that time, we would have seen the appropriation bill for 2026 come out. So it's not necessarily impacts the capacity of the government to spend on CAPEX. What would impact that is the availability of the funding itself. The budget gives direction, but even without it, we know the government will continue spending in the short term. Ours is not like the case of the US, where you have a government shutdown if there is no extension of funding for it. So it doesn't really impact. It just keeps investors watching to see what will happen. And nevertheless, even especially for CAPEX, we know that the new budget will make provisions for the completion of capital projects. So with that estimation, we can work with that while we await the new budget.
Yeah, I understand. What I was actually aiming at is, so we have sectors that would benefit from early budget presentation. So companies that are into like infrastructure that help government to, build or support the infrastructure development of government, and even for consumer goods. I'm, just wondering if an early presentation of the budget could aid these companies in, in their plans for the year. But as you said, government can continue to spend, I think, until, is it the first 6 months of the year before they can continue to spend until that
Yeah.
time before they make the budget presentation.
Well,
So,
they can continue to spend into Q1, but the earlier we get the budget, the better for direction. But even when the budget is presented, it doesn't mean the funding is available to start executing.
Dipo, how does this fiscal, I would say it's fiscal uncertainty now, how would it impact the bond market? Because recently the Q4 borrowing plans was revised, and we suddenly now have a situation on our hand where government is borrowing about 500 billion every month. Now this is just for 2025, so we don't know what the plans for 2026 will look like. Don't also forget that's going to be a year before the election, and there's also calls on the government to increase maybe spending for security and all that because of the security challenges that we have. So we are at a limbo to say, because we don't know what the expenditure or the borrowing plans of government will look like next year. So how do you think this is going to impact the stock market, or especially investors' appetite for Nigerian debt instruments?
Well, I think for me, and I will toe the line of Andrew. And firstly, it's the fact that um, it would have been good for it to actually come earlier than later. And but on the other hand, it's the fact that the market actually thrive on informations like this, and that's how the market plan. Imagine you already having the budget. Now you have an idea of what will be the total expenditure for the year 2026, and that can also help you to actually think around what would be more like the expected revenue. And then you start looking at what will be the average oil price for the year. And then you also look at what will be the exchange rate conversion. And that, to a great extent, tells you where the government is expecting the year to actually close. And don't forget when the budget for this year was released, the government mentioned that by the end of the year, inflation will be at 15. I'm sure a lot of us actually came at the government around that is too bullish. But the way it's going, we will likely close around that level. It simply means that they are seeing what we will not see at that time. So, what imagine we now have such information now on our hand now. It helps us to actually plan as investors, as trader, as portfolio manager in the markets. But without this budget, one of the concerns is that in the month of January, we all know that the DMO is always bullish at the beginning of the year. Of course, you will not blame. It's a time where you need to actually kickstart and start strong. So the fact that there's no calendar, there's no budget that we need to work with, it simply means that the DMO will not even be aware of what will be what will likely be the total borrowing for the year 2026. What portion on it will be actually borrowed locally? What portion on it will likely to actually visit international markets for? So what they will actually do is that they will come to the market blindly at the beginning of the year, and that's one of the things why I never wanted this to actually linger to that extent because it means that we will likely see a DMO that can come to the market and borrow 600 billion in January, another 600 billion in February, maybe another 1 point something trillion in March, and so what they are trying to do is to actually front run the market, knowing fully well that the budget will come at a time. So they don't have an idea of what volume is coming on their part to actually borrow from the market. So for them not to actually not have to start doing more like a catch-up strategy, they need to actually front load the market. And that particular point in time, will likely see market very soft. And that would do is that would likely push yield northward, despite the fact that other indicators should actually pointing towards a downside movement of yield. And that's one of the things why I feel that I'm not so much happy not to have seen what the expected budget would be. For me, in my head, I think the budget will be not of 60 trillion, if I'm not wrong, because there are other factors that we need to actually push into this. We are talking about actually doing a sensor. If you are doing a sensor, you have an idea of what the total cost of actually running a sensor. And don't forget, last year we did over about 54 trillion. And considering the fact that we are looking to actually improve revenue in the year 2026, and also when you now gauge what other states, what the state governments have been doing, and for example, Lagos that did about 3.1 something last year. Currently, they are doing about 4 point something. I think about 4.2 trillion for the year 2026. So it gives you an idea of that a lot of even at the state level, they are trying to push up the budget for 2026. So in the same direction, I expect the government, federal government, to also do that. I'm not expecting any budget less than 60 trillion for the year 2026. But what portion of it are we actually expect to actually generate in front of revenue? We've seen the stellar performance of the FRS for the which is now the Nigeria Revenue Service for the year 2025. I think by the month of August, they met their target for the year. So it tells you that they have better capacity to generate revenue. So, but now coming to the year 2026, how much of this budget for the year can they bring to the table? So as revenue, so how much of it do we need to actually now have to actually find a way to actually raise? What are the modalities for raising this fund? Are we going to be more aggressive in the local market, or we are actually would likely actually approach this international financial institution to actually get funds at a lower rate? So these are some of the things that would have been able to actually tidy up in December. I would have been able to start running from January. But now it means that we'll go into a year where there's no clarity. We don't know where we're going. How fast do we need to go, or how slow do we need to move? And that's one of the things why I feel that it will actually affect the trading in the debt market.
Yeah, that's a major concern because we earlier on when we started, you were actually projecting yields to drop, but with this uncertainty, and we don't really know whether come Q1 whether DMO will be borrowing for the completion of the 2025 budget or as in preparation for the 2026 budget. So all this confusion would definitely mean that investors might want to, take a sit and wait approach before, really jumping in. Now, let me bring Andrew, since you already talked about the Nigerian Revenue Service, the IFRS, and the amounts now that have been able to generate in the last 3 quarters now. Andrew, do you have any idea of how the performance of the 2025 budget is at this time? And also, how do you think that the new Nigerian Revenue Service, because obviously they will have a lot of enforcement to do for the equities markets, could like better revenue enforcement by the FRS risk, higher compliance costs for companies in the stock market? Would it hit their margins?
Well, there's the possibility of that happening, especially for maybe medium-sized companies that prior to now have looked for ways to avoid or even to some extent even evade those tax payments. So there is the increased scrutiny, that the new tax law brings on board, and then the measures that are being put in place to ensure implementation might actually lead to increased compliance costs. But that risk I see for medium-sized companies. For large corporates, actually that have, standard reporting disclosure procedures. They have very well, I want to say reputable accounting firms as auditors, but in recent times we've seen that even that is not something one really wants to really rely on. So on medium-sized companies, we may see that increased compliance costs, but I think the corporates, the large corporates, which should weather the new tax act, pretty well. It's not really an increase in the amounts they are required to pay in terms of the percentage. Is just increased enforcement to ensure compliance. So that's the impact I think it will have.
Oh, all right. So yeah, so talk to us, Andrew. At the close of market on Friday, First Bank, that's the First holding company, they announced full completion of their divestment from FBNQuest merchant bank to, I think, EverQuest. I imagine that is going to unlock capital for recapitalization drive for First Bank. So with this new merchant banking arm now gone, how does it reposition First Bank as a tier one or in their bid for tier one race against their peers like Zenith and GT Bank?
Okay. So the commercial banking license that it already has, and then so it's the First Bank Holding Group has a subsidiary, the commercial banking license, the flagship subsidiary, and also First Capital that has an issuing house license. Okay. I think if you bring both of them together, the functions that were being performed by the merchant banking arm can still be performed by both of them, both on the capital market side and then on the banking side. So it's the exit, the sale, the divestment from that particular arm, I don't really see it as significantly impacting their position. The cash flow will come in from that divestment to support their recapitalization, but as we speak, First Bank is still in the market to meet up its recapitalization. The last we heard, there was going to be a private placement to get the balance, while the likes of Zenith and GT have already scaled that hurdle. I believe First Bank will scale, but the divestment from that arm does not necessarily put them in any better position, compared with their peers in terms of being able to maybe corner the market or do some larger transactions. The pairs in question have already met their capitalization deadlines, and Zenith is not a holding company, GT is a holding company, but you also have those same functions replicated within the ecosystem of its competitors. So it's not really a major play for them.
Okay, because I was thinking that with that divestment, that would mean more capital coming into the bank in their quest towards the recapitalization drive. I'm not sure that I don't have an idea of what the figures look like, how much the company was sold for. I don't have that information.
Yeah, I don't have it today. That was not made. It was not made public.
It wasn't made public, right? Dipo, were you tracking this news last week?
No, it was not made public.
Okay. All right. So, I mean, as we begin to wind up, Dipo, what do you expect from now to the end of the year in terms of PFA, banks, and offshore players, their activities in the Nigerian bond market? What do you expect? And also Treasury bills and HOMOs. What do you expect going forward?
I think we continue to see offshore player actually grazing our markets. And I think I mentioned something last week that we'll be likely be coming back on the JP Morgan fixed income index. And so what it means is that we'll see broader exposure of our market into the global markets. And we'll likely see a lot of patronage from people actually mimicking the index, and that will likely increase level of activity in the markets. Considering that this information is already going around the market, and behind every rumor, there's also always a sense of truth. And what it means is that some guys may already be front running the market as we see currently. I will see what the history looks like when these guys came to the market the last time. I'm sure you can still remember where we were trading at single digit on some of these instruments in the market then. And I remember then a 30-year instrument traded as low as 8.5. 20-year instrument was trading 7% in the markets at that particular point in time.
You
And
remember 5 is 5?
yeah, very well. 4S4 and all. So when you look at that from that perspective, having a 16%, and that's why I keep saying it, that so that it will never be a regret. And just like we say, the only pitfall for this was what we mentioned around the budget, and because that's only more like what will actually affect the clarity that we are already seeing in that line. And but the soccer is that we're going to have MPC come back in the month of February, and expecting inflation to actually continue to actually on its downward trend. Of course, it simply means that we'll likely see a jumbo rate cut, and if that happened in the month of February, we'll not be surprised to actually see a jump in yield downward. Imagine a 400 basis point rate cut. Of course, it simply means that we can see rate trade as low as 14% in the market, and nobody will question why those instruments are actually trading around the line. But for banks, they will continue to play more like in the almost segment. So don't forget that what they are picking is return, and these are some of the things that even investor looks at when they're actually buying their stocks in the equity markets. So when you see short dated instrument, a 250-day OMO bill that is yielding close to about 24-25%. Of course, it would not be a bad idea for some of them to actually do that. And don't forget, currently, because considering that the corridor adjustment rates now around 22.5 when you're actually doing SDF. And what it will mean to some of these guys is that rather than taking this money to CBN window at 22.5, then I would rather just invest in automobile. But also, what we are thinking currently is that I won't be surprised if CBN now cut down OMO rates now, considering this adjustment that has been done around the corridor, so that rates would have
another possibility to that.
So that rate can now come around that 22 point something levels on that side as well, so that there's no room for arbitrage opportunity for banks. You understand in that regard. So I think the banks will play more in the OMO space. I think the PFAs guy will continue to actually invest in the bond market, looking for instruments. And don't forget that currently the best instrument for PFAs they are more like long dated instrument, like a 30-year bond and a 20-year bond. And it's been long that we actually see some of these instruments in the market. The last we saw was 2023 when the 2053 bond was issued. Between then and now, we've not seen anything in that likeness in the market again. And that's one of the reasons, because of the depth of this long dated instrument. These instruments are trading around 14.5 levels in the market now. So they will continue to come to actually look for instruments that are actually long dated in nature. And also, they will play at the belly of the curve, where we actually see this 33, 35 trading. And not a bad deal for them to actually lock in. Portfolio managers also will actually play in that segment of the market. So beyond this thing, the main catalyst that will drive market in December will be what will be the action at the December bond auction. Will the DMO actually go over and above to actually sell? We understand that this will also lead, but based on the norms, towards the end of the year, you see portfolio manager rebalancing their portfolios. You see people trying to take position over the year end, and so I won't be surprised if we actually continue this level and close sub 16% by the end of the year.
Okay, thank you. Let me come to Andrew now for my final question. I know that a lot of people might have been expecting MPC to reduce rates to maybe cut it by about 100 basis points, but that didn't happen. If investors are looking to add any stock or sectors to their portfolio, what stocks are you going to be advising them in the weeks ahead, especially from now going to the end of the year?
Okay. So I would stick to industrial goods and telecoms. For industrial goods, the key player there, as at half year, had already beat the full year EPS for 2024. So the expectation is that we'll see an increase in dividend payments, and then technically it's currently trading very close to, it's trading at an attractive entry level. Then for telecoms, again, the major player in that sector should benefit from the increase, the tariff increases that we just saw, and the last result we saw was very healthy to the extent that an interim dividend was even declared. So I'll stick with industrial goods and telecoms.
Okay. Dipo, any final words from you? What should we be looking at for this week?
Well, for this week, I think the market will focus on the NTB auction that will be coming up. Of course, we'll see pockets of cherry picking on the bond space, but nothing extraordinary to actually drive market direction. And don't also forget that the market still awash with liquidity. The central bank may also be in the market to actually reduce the level of liquidity in the market. So I will feel that market will just trade sideways throughout the week, and maybe post auction we may likely see a bit of activity if the DMO decided to actually close rate below 16%.
Please add your view about the exchange rate as well. I know MPC maintained at 27. Where do you see the Naira trading? I think it was trading, 1,450 or one thereabout. So
it traded as low as 1,438 post MPC meeting. But what we noticed was that after the meeting, we saw inflow of fund into our market by most of these foreign guys. So that actually increased the level of liquidity at the MFM window, and that actually pushed rate downward. But we saw a bit of pullback around the 1,440 levels, and that's where it actually closed at the end of the week. But when you go back to the month of September auction, MPC meeting, the central bank governor, no, not the meeting, there was an interview where the central bank governor actually mentioned that by the end of the year, they expect rate to actually close at 1,400. And we are just 40 naira apart from that. Yeah. Do you think that is possible? I think that is possible.
I think that is possible if we continue to also see inflows that we normally see around.
And also we have robust reserve to actually give assurance in that regard. So I won't be surprised if by the end of the year we close at 1,400, because even at 1,400, Naira still remain underpriced.
Yeah. Okay. Thank you so much. It's been a wonderful time chatting with you, gentlemen. So we'll see how the market pans out for the NTB auction. I expect there's going to be OMO auction as well. And we'll also be taking a close watch at what happens with the T+2 settlements, whether history would repeat itself, whether we'll see increased turnover from the mid-cap stocks, and we'll see how that plays. Thank you so much for joining us, everyone. Please do not forget to like this video, subscribe, share, put down any comments you have for myself or my esteemed guest, and we'll be back to provide answers to them in our next edition. Thank you and have a great week.
Thank you very much.
Thank you, Doctor. Thank you.